Welcome to Talk Tickers.
Great to be here.
Today, you're tuning in for our deep dive into the recent third quarter fiscal year 2025 earnings call for Affirm Holdings.
Yep.
We've waded through the call, pulled out the key details, really trying to bring you the essential insights here.
And it was a positive quarter for Affirm. They actually came in above their own forecasts.
Okay, so better than expected.
Yeah, and they've bumped up their outlook too for Q4 and the full fiscal year. So some definite optimism there.
Interesting. What's underpinning that positive feeling?
It seems to be a few things working together. They kept hitting on this theme of balancing growth with really solid credit quality.
Right, not just growth for growth's sake.
Exactly. And focusing on lifetime customer value. Plus, they mentioned, making progress towards actual GAAP profitability.
It's always a good sign.
Definitely. All while being, as they put it, judicious or, let's say, careful with their spending.
So growth, but smart growth. Discipline.
That seems to be the message, yeah. And the numbers seem to back it up. Gross merchandise volume, the GMV.
The total value of stuff sold.
Right. That showed broad strength. Pretty much strong across most categories. I think only one category dipped slightly.
Wow.
And it wasn't just the huge partners driving it. They saw good growth with smaller merchants too.
That's important for diversification.
It is. And interestingly, their direct-to-consumer services, especially the Affirm card, that actually grew faster than the overall business.
So the card's getting traction?
Seems like it. And another point they made was that GMV growth actually picked up speed during the quarter.
Oh.
Yeah, March was apparently the strongest month, hitting something like 40% year-over-year growth.
40%. That's significant momentum heading out of the quarter.
It really is. Suggests a good trend line.
Okay, let's dig in a bit more then. You mentioned the card, but another big piece seems to be these 0% APR loans. What's the story there?
Affirm sounds really bullish on their 0% APR product. They said it's getting excellent traction.
Right. Now, okay, these loans might bring in slightly less revenue right off the bat compared to ones with interest.
Makes sense.
But they see huge value beyond that immediate revenue. Things like, brand building, helping merchants convert more lookers into buyers.
Conversion lift, yeah.
And just the overall long-term value they get from those customers. They even pointed out that these 0% deals bring in more first-time Affirm users compared to interest-bearing loans.
So it's like an acquisition tool almost, a strategic investment.
I think that's exactly how they see it. And what's really interesting is the type of customer it attracts.
Oh, yeah.
The credit quality on these 0% loans is notably better. It's mostly prime and super prime borrowers taking them up.
Okay, so lower risk profile.
Definitely. And these are folks who are probably great candidates for the Affirm card later on. So it boosts that potential lifetime value significantly.
And are merchants pushing for these deals too? Often, yes. They said merchants frequently come to them wanting to run 0% promotions. And Affirm is usually happy to oblige because, well, it works for everyone.
Win-win. But how do they keep it transparent? 0% sometimes sounds too good to be true.
That's a big focus for them. They stress no hidden fees, no retroactive interest if you miss a payment, none of that.
Okay, that's key.
Yeah, they believe that builds trust, gets positive customer feedback. They really view 0% APR as much a brand building exercise as a way to drive GMV.
Interesting.
And the decision on how much to lean into 0%, it's also tied to how well the rest of their loan portfolio is doing.
How so?
Well, because their existing loans are profitable, they have, let's say, surplus profitability, they can then decide to reinvest some of that into these 0% offers to fuel growth and grab new users. It's like using today's success to fund tomorrow's growth.
Got it. Makes strategic sense. Okay, shifting gears a bit. Recession fears are always lurking somewhere. How's Affirm preparing for any potential economic bumps?
They seem pretty proactive. They mentioned they regularly run models for different recession scenarios.
Standard practice, I suppose.
Yeah, but they draw on their own history too.
Yeah.
Like what they learned during COVID or that slightly rockier period in 2022, 2023.
Right.
So they make conservative guesses about how their current loans might perform in a downturn and figure out what tweaks they need to make to their upfront credit standards.
To protect returns for investors and keep the capital markets happy.
Exactly. That's the main goal, ensuring they can still meet their obligations even if things get tough economically.
Are they looking just at big picture stuff like unemployment rates?
Actually, they emphasized focusing more on early warning signs within their own loan book.
Ah, internal data first.
Yeah, rather than just reacting to, say, the national unemployment figure, they feel looking at their own customer behavior gives them a quicker, more relevant signal if stress is building.
Like taking your own temperature instead of just reading the weather forecast?
That's a great analogy, yeah. More immediate, more specific to their situation.
Okay. Now, something else they seem quite vocal about is reporting loan data to credit bureaus.
They are. Affirm really positions themselves as being at the forefront of the BNPL industry on this.
Is it technically difficult?
They said that part's straightforward, but the implementation took years of testing.
Testing for what?
To make sure it was accurate, obviously, but also that it actually helped consumer credit scores, or at least didn't unintentionally hurt them.
Avoiding negative consequences.
Right. Their stance is that most people want their good payment history reflected on their credit report.
I mean, yeah, if you're paying on time.
Exactly. So Affirm sees it as simply the right thing to do. Helps people build credit, and it also gives a fuller picture of someone's debt, which can help prevent, loan stacking.
Taking out too many loans across different places.
Yeah. And they're actually encouraging competitors to start reporting too. Plus, there's a benefit for Affirm by reporting. They get access to richer credit data themselves.
Which helps their underwriting.
Potentially, yes. Better data could lead to lower risk over time compared to lenders who aren't seeing that full picture.
Makes sense. Okay, let's swing back to their own products, the Affirm card. What's the latest on that strategy?
It's clearly a major focus. The big goal is getting it to be that top-of-wallet card for users.
The default choice.
Right, and that means continuing to build out the features people want and expect. Like they mentioned the Pay Now function.
Spending directly from a bank account.
Yeah, but they expect that part to roll out gradually. It's not an overnight switch. Recent additions, like supporting foreign transactions, are all about improving the experience and encouraging people to use the card more often.
Are they using special incentives to get people using the card?
They're looking at different things, but honestly, their testing keeps showing that 0% APR is still the most powerful incentive they have.
Back to the 0% again.
It seems to be their killer app, so to speak. They also mentioned working on their API, the tech side, to make integrating Affirm products, including the card, easier for partners.
And the Affirm app itself, what role does that play?
Its main job right now is still loan repayment. That's priority number one, don't mess with repayment rates.
Absolutely.
But it's also becoming a catalog, a place to see which merchants have offers, especially those 0% deals.
A discovery tool.
Yeah. And looking further out, they kind of envision the app becoming more like a search engine for financing.
How do you mean?
Like you want to buy something, you go to the app, and it helps you find the smartest way to pay for it using Affirm.
Personalized finance search.
Exactly. And they hinted that future versions will likely use AI to make that search experience even better.
Interesting. So the app becomes more central. What about looking outwards, international expansion?
The big news there is the partnership with Adyen. That's meant to speed things up, especially getting into new markets like the UK.
How's the UK progress going?
They said it's positive. Still early days, focusing on sales, educating merchants since Affirm is newer there. A really big step for the UK will be when they integrate with Shopify there. That's planned after the current beta test finishes up in Canada.
Got it. You mentioned AI for the app search. How else is Affirm using AI?
Oh, they've been using machine learning for ages, since day one, really. Primarily for credit scoring, but lots of other stuff too.
So AI isn't new for them?
Machine learning isn't, no. But now they're actively adopting the newer stuff, large language models or LLMs.
Like ChatGPT tech?
Sort of, yeah. Using it internally for things like analyzing merchant contracts faster, boosting productivity.
Okay. And customer facing?
Yes. They mentioned using a combination LLMs for the user interaction part, machine learning for the back-end processing to improve customer support, especially for handling disputes.
Making it faster, more transparent.
That's the goal. They see machine learning is better for precise things like underwriting where you need predictability, while the Gene AI, the LLMs, are great for those more flexible user conversations. Makes sense to use the right tool for the job. Okay, let's talk credit performance. How are the loans actually doing right now? According to them, repayments are healthy. They said they're not seeing any broad signs of consumer credit stress in their portfolio currently.
That's good news.
Yeah. And they actually saw a slight increase in prepayments during the quarter. People paying loans off early.
Which is usually a positive signal, right?
Generally, yes. Their allowance for loan losses went up just a tiny bit, but they feel it's still in a healthy spot. Delinquencies are really the key thing they watch as a leading indicator.
So overall, looking okay for now.
That's the picture they painted. But they were quick to add, they try to be intellectually honest about credit. Things can change fast.
Sure.
But because their loans are short-term, they feel they can react and adapt pretty quickly if needed. Vigilant, but okay for now.
Right. And what about the competitive landscape? Still pretty intense in buy now, pay later.
Oh, yeah. Very competitive. You've got the pure play BNPL folks and the big established financial companies all in the mix.
Is Affirm having to cut prices, like merchant fees, to compete?
Interestingly, they said no. Their merchant fee rates have apparently stayed consistent, which suggests they're not trying to win primarily on price. Their focus seems to be more on, like we said, conversion rates for merchants, the impact they deliver, and building that brand value with consumers.
Value over price. Okay, a couple more specific things. Any talk about getting a bank charter? Some fintechs go that route.
They address that. Right now, a bank charter isn't seen as the answer for their funding. They think gathering deposits would take too long, and there are regulatory limits.
So not for funding. Any other reason they might consider it?
Maybe down the road for regulatory certainty, or if there are specific product features they want to offer consumers that require a charter.
So it's feature-driven, potentially.
That's what it sounded like. If they need a charter to build something specific they think consumers need, they'd look at it then, but not for funding itself.
Gotcha. And quick updates on big retail partnerships, Walmart.
They said they're live at Walmart, the partnership's strong, and they're continuing to invest in making it work well for Walmart.
Status quo, basically.
Pretty much. They said they'd communicate any big changes if they happened.
Okay. And Costco, that was newer news.
Yeah, they're very excited about the Costco partnership starting online. They highlighted Costco's strong consumer focus.
Any timeline for rollout? Or thoughts on going in-store eventually?
No specifics on timeline yet or in-store potential.
Yeah.
They basically said these big partnerships take time to launch, tune, and optimize.
So manage expectations on immediate impact.
Right. They're not updating their financial forecasts based on it just yet. Needs time to ramp up.
Makes sense. What about the Shopify partnership renewal? Do they have to give up anything economically for that?
Apparently not. Renewing the deal through 2028 didn't involve economic concessions.
Good for Affirm.
Yeah. The main change was extending the amortization period for the warrants they originally gave Shopify. It has a small impact on the P&L, but no major economic shift.
Okay. One more potential headwind, student loan repayments restarting, and potential wage garnishment. Is Affirm worried about that?
They said they're mindful of it.
Yeah.
Their underwriting models apparently already consider student loans, whether someone has them, if they're delinquent based on past data.
So it's already baked in to some extent.
To some extent, yes. But they'll obviously keep a close eye on whether actual repayment behavior changes significantly because of increased enforcement, and they'll adjust their models if needed.
Watching the data, basically.
As always. And one last quick clarification. Sales and marketing expenses were down this quarter. Why was that?
Ah, good catch.
It was mostly because the amortization period for those warrant expenses related to a big partner, likely Shopify, ended last quarter.
So it's a one-time drop related to accounting.
Essentially, yes.
Yeah.
They expect the sales and marketing expense level from this quarter to be the ongoing run rate for the next quarter.
Okay, that clarifies things. Well, this has been a really thorough look at Affirm's quarter.
Definitely covered a lot of ground.
All right, let's move to our final segment, the this is not financial advice part, where we toss around some, let's say, creative trade ideas based on what we heard.
Always fun.
Okay.
Idea number one, playing off that strong 0% APR traction and the prime, super prime borrowers they're attracting.
Right.
So maybe an outrageous but plausible idea is go long on a traditional credit card company that also focuses heavily on those prime and super prime folks.
Why?
The thinking is, Affirm's success might be a signal that this high credit quality group is feeling confident, spending more, maybe borrowing more. That could be good news for established card issuers targeting the same demographic.
Okay, that's the plausible part. What's the outrageous part?
Pair that long position with a short position on a different BNPL player, specifically one that relies more heavily on subprime lending and makes a lot of money from late fees.
Ah, betting against the other end of the BNPL spectrum.
Kind of. The idea is Affirm's focus on quality borrowers and credit reporting might put pressure on BNPL models built around fees from riskier customers. Contrast play. But again, purely hypothetical.
Understood. Outrageous but plausible idea number two.
This one leans into Affirm's app strategy, turning it into that financial search engine, maybe with more AI down the line.
Okay.
Consider a long position in maybe a smaller, innovative AI company that specializes in personalized financial advice or user interface designed for finance apps.
Betting on the enabling tech.
Sort of. And the outrageous twist. Simultaneously short a traditional financial comparison website.
Like the ones that just list credit cards or loans.
Exactly. The bet here is that Affirm's integrated, AI-powered approach within their app offering financing and helping you find the right way to finance could eventually disrupt the older model, just listing options without that deep personalization or ability to transact right there.
Interesting. Betting on integration and AI disrupting simple comparison.
Again, just an idea to chew on, definitely not advice.
Absolutely. Food for thought only.
Yeah.
So wrapping up our deep dive into Affirm's earnings call today, we've really seen a company focused on strategic growth, careful credit management, and definitely leaning into technology.
Yeah, key themes were definitely the success of 0% APR, their proactive recession planning, the push for credit reporting transparency, and that evolving app strategy.
Important takeaways. And just to reiterate one last time for everyone listening, nothing we've discussed constitutes financial advice. Please, always do your own detailed research before making any investment decision.
Absolutely crucial.
We definitely encourage you to dig into Affirm's own investor relations materials, see how these points fit into your own view of the market, what parts of Affirm's strategy stand out most to you. Feel free to continue the conversation online.